finances, wealth, wisdom, stewardship, legacy, God's design. Get ready to learn about the gospel of finance. Let's get started.
If I had to give advice to my children, and I am, about retirement and what vehicles they need to be using in retirement, or just general information that we would give to anybody, what would that look like when it comes to the issue of retirement? Because retirement is something that everybody has to think about, but I think we have the wrong definition of retirement. When you start looking at retirement, the challenge is going to be one area alone. It's going to be cash flow. So I don't care how much money you have in retirement vehicles, whether it be 401k, IRA, makes no difference. The end result is this. The end result is, can the cash flow last you your entire life? Now, when you're planning for retirement, what most financial planners overlook is really, it falls down in a couple of areas. The first area is this. When you're in retirement, number one biggest issue is cash flow. We just talked about that. The second thing that is most important is taxation, because you want to make sure that those two things are working together so that you can maximize your years in retirement. Because on average, the retirement for an individual is scheduled at about 25 years. So your money needs to last about 25 years. Based on actuarials, and actuarials are studies that are done by insurance companies. Those actuarials predict the length of life for the average individual. And the length of life for the average individual in the United States is 92 years old. But only 1% of the total population of the United States makes it to 92. Most of your policies, insurance policies, have a term of about 120 years. Believe it or not, that's based on Genesis chapter 6, because God has given us 120 years on this earth. And so they use that, believe it or not, as a guide to how they structure term life and what's called permanent life insurance. But in looking at, again, retirement, how do we structure retirement? How do we set it up? And how do we maximize it for those? And I'm talking, again, to those that are young, starting off relatively young. And if you think you're young at heart, listen, go ahead and throw yourself in there as well. We have to take a look at a couple of different vehicles. Now, if you've heard or listened to any of my previous videos, I'm not a big fan of 401ks. I'm just going to go ahead and say it. Not a big fan. The reason why I'm not a big fan of 401ks is because 401ks, again, they were designed specifically at its inception for the employer, not the employee. The second reason why I think it's a bad move for most individuals is because when it comes to taxation, that particular platform, the 401k, is the highest tax platform out of most, if not all, of the retirement vehicles that are on the market. And so why would you put yourself in a vehicle that you know you're going to pay high taxes in? And when you start looking at the volatility of the market, at times, you start looking at management fees, you start looking at taxation, you could, again, realistically lose up to 40% of your entire portfolio before you draw the first dollar. So what does that mean for you in numbers? Well, if I took 30 years, because the average 401k balance is right around between $105,000 and $110,000. Let's just use $100,000 for simple math. If you have $100,000 that you sweated and bled for over the last 30 years, and now you've got that $100,000 towards your retirement, which is far short of what you should have in there, but that's where most people are. What happens next? Well, management fees up to 4%, market correction, and taxation, because what ends up happening is that $100,000 now puts you in a higher tax bracket. You can manage the tax bracket based on your draws, on when you draw the money. Now, with that scenario, again, you can lose up to 40% of your portfolio. Not a good idea. So when you look at vehicles that can help you to keep all of your money, what do? You find those vehicles. Now, there are certain vehicles you use for investment. Those are the high risk, high reward type of investments. that if you put your money in there, you could have a windfall overnight, or you can lose your shirt overnight. Would like to stay away from those if you're looking at retirement, because you want steady and consistent growth. And so when you start looking at the vehicles that provide steady and consistent growth, the best ones to take a look at, number one, would be in a Roth IRA. Now, the Roth IRA is still an investment vehicle, all right, that is in the market. The potential of loss is there. So if the market corrects or if the market crashes, even in your Roth, you can lose money because it is designed, set up to be an investment. The second thing you look at is you want to consider mutual funds, because mutual funds, again, when you start looking at the platforms that offer tax-free income, Roth IRA, because it's all after-tax dollars, there's still a possibility of some taxation based on gains and some other things. Very minimal, wouldn't worry about it. Mutual funds, again, would be another platform that if you want tax-free income, then mutual funds are a good way to invest. So Roth IRAs, mutual funds, and lastly, you want to take a strong look at Index Universal Life. Now, Index Universal Life insurance contracts, yes, I said insurance, it is insurance, but it is a guaranteed setup to where you have consistent growth. Now, the benefit and the blessing behind that is this. IULs, Index Universal Life policies, typically outperform the market, believe it or not. And we've seen some that actually, as far as the return on investment, the interest rates that are credited to the accounts can go up to about 24, 25%. I've actually seen that. So that's something you want to keep in mind. Typically, though, the average is between 6 and 8%. When you look at IULs, they will oftentimes illustrate on the lower side. And why do they illustrate on the lower side? They illustrate on the lower side because of lawsuits. Because if I tell you that you're going to make 10% and you're only making 6%, then guess what some people are going to do? They're going to take you to court. So what they do as a strategy, they will actually illustrate on the low side, which is typically about between 6, 6.5, sometimes 7%. But in all actuality, when you start looking at what's called illustrations, they illustrate a lot higher. They actually illustrate between 10 and 12%. But again, you have to take a look at the illustration. You have to know the individual. And also, too, the danger behind IULs is that you may have someone that's not familiar on how to set them up properly. And that is something that you have to make sure you take into account. What do you mean, set it up properly? Well, the way IULs are set up is kind of smoke and mirrors, bait and switch if you're not careful, if you don't know what you're looking for. Because you have some individuals, some, not all. It's not representative of the total market that's out there that's selling IULs, but some can actually set it up to where they get a larger commission, where you get the lowest amount of growth inside your IUL. The proper way to set it up is to make sure that you get the maximum cash accumulation inside the IUL. What does that mean for the person that's actually writing the policy for you? That means that if I give you the maximum amount of benefit or the maximum accumulation, cash accumulation in that particular account, guess what that means for me? That means my commission is going to be a lot less. Now, those who are professional, those who have experience, and those that understand the process don't have a problem with it, because we understand and we know that overall, if we do good by our clients, then good will come. But you do have some people out there, they're unscrupulous. They got what they call commission breath, and they're going to go after these IULs, and they want to make a lot of money. You know, I had one client that the annual premium the monthly premium, on the IUL was about $1,500 a month. You have some, I had one with about $3,500 a month. Now you're talking commissions between $20,000, $30,000, $35,000 potentially, depending on the carrier, depending on the setup, but you can make some very high commissions on these products. That's the danger. That's why you have to know on the IUL side what you're looking for. Now, again, with Roth IRAs, you got to understand the market. You got to make sure that you understand and know that these are subject to loss depending on the market. Roth IRAs, unless you have some type of personal private account, if somebody is managing that money for you, then you're going to pay some fees. And so you will lose money through market corrections. You will lose money through management fees. Mutual funds, pretty much the same way. But when it comes down to your 401k, you're talking about market corrections, you're talking about management fees, you're talking about taxes on top of that. So these three here are tax-free. So again, Roth IRA, mutual funds, index universal life. These are the three that if you're going to put up a portfolio, if you're going to put one together, these are three that you need to make sure that you're funding, that you're putting money into some kind of way. This is separate again from what we call investments. So if you're investing money and you're trying to make a whole bunch of cash, that's all well and good. Invest that money, make the cash. You want to invest in the stock market, crypto, whatever you choose to do. Once you make that money, what you do is you take a portion, if not all of that money, and you put it into your retirement vehicles. Now, your retirement vehicles are what's called retirement savings. You have investment accounts, you've got retirement accounts. Retirement accounts are typically savings accounts. Now, the savings accounts, again, can be used for investment, but they are safer in nature. And this is what you want to make sure that you have, because again, you don't want to work 30 years plus and have all this money saved up only to lose it because the market corrects right before you choose to retire. And I've actually had that happen. I had a client that was putting money aside and had an account with, I'm not going to say the name, but the initials are EJ, and they had the money in this EJ account, and the market started correcting. Now, the people that were managing the money told her, listen, hold on, because they tell you, listen, what you need to do is hold on for the long term. But this is a single mother with 2 kids, and she's the primary breadwinner, no longer married, and she's trying to make it work. She's literally watching her retirement go away. She put in, she worked hard, she got to the place where she had between $20,000 and $30,000 in the account. And in a matter of a week, she watched it dwindle down from $30,000 to about $18,000. Now, when we're talking on the phone, is she crying? Yeah, she's crying. What we were able to do is switch her into something that was more stable, locked in, and was able to get her gains. Now, she's going to get them all back. She probably will. It'll take a little bit longer because of the amount of money that she lost, but she is gaining with regards to what we put her in. And at the same time, she's not worried about now the loss. Now, the difference between, I'm going to give you this and we're about wrapped up, but the difference between a Roth IRA, mutual fund, and an IUL, all three we need to be considering. Now, 2 out of the 3 are guaranteed to lose money. The Roth IRA, because when the market corrects, again, you will lose money. So the mutual funds, again, mutual funds, pooling your money together with other people. Again, when you start looking at taxation on that, it can be a tax-free platform for you to grow your money. But at the same time, when the market corrects, you will, at some point in time, lose some money. And I'm talking about historical averages. I'm talking about over the last 10 years. If you have your money in these vehicles, you will lose money over the next 10 years. But with IULs, with Index Universal Life, this is the only platform that you will not lose your principal. You will not lose any type of interest that is gained. That's why they're so popular in the industry. I've had a conversation with somebody who's not licensed to sell Index Universal Life. They can only look from the outside in, and based on what they know, based on what's been told to them, and based on what their company is saying, they're telling them that IUL is a bad investment. Well, number one, it's not an investment. Number two, it is insurance, but it is insurance designed specifically for cash accumulation and growth for retirement. And there's a way that you set it up to where you can actually receive that money and that money be tax-free. I did an illustration to put a policy in place for a client, and they were doing about $10,000 a month. $10,000 in retirement a year is what they're going to be pulling. But they were doing about $1,000 a month. And with that money, what they'll get in retirement is $10,000 a month, tax-free. Let me say it again, $1,000 a month that we're putting into the retirement vehicle, and it's still active policy today. Matter of fact, it was my first policy. And putting that policy in place, the person, again, has $10,000 a month coming in tax-free. Now, why is that important? And why you need to look at these? Why is it an important mindset to have in retirement? A couple different things. Number one, we know that in the next 10, 15 years, the value of the dollar will go down. Second thing that we know is that in the next 15 to 20 years, taxes will go up. If you have not noticed, the cost of living is increasing even as we speak. I don't care which administration is in place. I don't care what president you like or don't like. Taxes over the last 15 to 20 years have gone up. And unless somebody does something administratively, politically, they'll continue to go up. So the cost of living goes up, taxes go up. That means this. That means the value of the dollar goes down. So now when you have platforms for retirement, what's more important? Because if the value of the dollar goes down, if taxes go up, then you're going to need something that's going to hold on to as much money as it can while you're in retirement. Roth IRAs may or may not make that happen. Now it's tax-free growth on that, definitely tax-free and you're pulling it out. So that may work. Mutual funds just depends because again, both of those, Roths and mutual funds, are subject to the market. And that's the one thing you got to consider. So now those two could potentially lose you money. The index universal life will typically, number one, not lose you money. It will actually gain you money, or there's a break even because if you're not making money, then you're not losing money. You're just simply at a break even. But typically they outperform Roths, they outperform the mutual funds over a 20-year span. And we've seen the numbers to prove that. That's something you want to keep in mind. Now, all three. So I'm not trying to talk you off the ledge. If you like Roth IRAs, good. If you like mutual funds, excellent. But consider also index universal life because these three, if you're going to look at retirement, and again, if I'm giving advice to my children, if I'm giving advice to somebody who's starting retirement, these are things you look at. Okay, you want to set aside, you want retirement savings. So the retirement savings vehicles, Roth IRA, mutual funds, index universal life. If you want to invest, okay, let's set something up different from that. And as we set up that different account, now you can go out there and if you win the world, you win the world. If you lose all your money, then you lost all your money. But your retirement is always protected. And inside that bubble of protection, index universal life protects your money the most. That's something to keep in mind. There are stipulations on how you get it because it is insurance. So I guess my last point in making is this. For those who argue, well, it's insurance, it's not an investment. Well, you have to keep this in mind. By definition, insurance is financial protection against loss. Let me say that one more time. Financial protection against loss. Webster's Dictionary, look it up for yourself. If you ever notice, if you go into the banks, and I know that everything's electronic now, we don't go into the banks as much as we used to, but if you go into the bank, there's a placard sitting right next to the teller. And that placard, whether it's on the counter or on the board or whatever they have there, it will tell you that it's the money in this bank is FDIC insured up to $250,000 per account. Now, what is FDIC? Federal Deposit Insurance. So banks insure their money. Investment companies insure their money. Brokerage firms insure their money. Why don't you insure yours? Index Universal Life is insurance on your retirement. It is what's called a private, forget the term. What's the term I'm looking for? Lost it just that fast. But before 401ks, before all these retirements, you had companies that set up life insurance policies that were given to their employees, and they were distributed out over a period of time. Let me say this last piece. I'll come back with the definition and what I was thinking about before. I'll give it to you the next go around. But when you start looking at the Index Universal Life, understand this. It is probably the best vehicle that you can use. I would not discount it. I would use it in addition to the Roth and in addition to the mutual fund if you're going the route. If you just set on investing, if you're setting putting your money into the market, Roth and mutual funds are the ways to go. If you want to simply invest and you just don't care, you want to go cowboy with it, what you do is set up an account and you set that account up and you make all the money you need to make, but learn how to shift the money, shift the profits, shift the winnings over to something that is safe and outside of the market, if at all possible, so that you can lose, so that you can win when it's all said and done. All right. So keep those things in mind. And on the next go around, like I said, we'll talk a little bit more. And as a matter of fact, hold on for just a second. It blew my mind, but I got it back. Pensions. So you want to set up a pension fund. Now, IULs are used as tax-free pensions or what they call personal pensions. So these are things you want to keep in mind. Consider this, mull it over, pray about it, think about it, research it. But in the end, you're going to find that these three vehicles, if you're going to set something up, these are the way to go if you're going to retire moving forward into the future. We'll talk to you next time.